Good evening, everybody. As I'm recording this at 5:33 Chicago time on December 12th, 2018, I want to welcome everyone to this YouTube presentation. I plan on doing many more YouTubes several times per week about market action and behavior. But this second YouTube that I'm doing happens to be one that I want to introduce the teachings of Richard D. Wyckoff. Richard D. Wyckoff was a trader, was born in the late 1800s, 1873, died in 1934. Richard D. Wyckoff was a person who was a trader and observed the market participants of the time. The Keynes, the Rockefeller, the J.P. Morgans, names that you heard about or possibly heard about for many years in the past. Today, those people are replaced by the Warren Buffetts of the world, the George Soros of the world. So basically the people that were very influential of the time, Richard D. Wyckoff followed in how they basically traded the markets. That's extremely important because as we know about markets, they happen to run based upon fear and greed. Basically, markets get overbought, oversold from the standpoint of when they're oversold, they become value to these great minds. When they become too highly priced, they become oversold to these great minds. Richard D. Wyckoff came up with the principles that you see on the screen. The three principles of Wyckoff are effort versus result, cause versus effect, and demand versus supply. These are principles, and since they're principles, they occur in nature, economics, and every part of the world. G. Wyckoff applied them to the areas of stock trading. G. Wyckoff believed that the market was of single mind, meaning that all the participants of the market collectively became the composite operator. We sometimes refer to them as a composite man, but he referred to them as a composite operator. These are the people that collectively gathered the information, conducted a campaign from a market that was from an oversold condition or a value condition to a market where it became greedy and the market become overbought or too highly priced. Richard D. Wyckoff was a master of the trading range. And because he was that, markets generally stay in these trading ranges. The composite operator conducts these campaigns and eventually moves the campaign out of the range, and he essentially will move it based on value. The interesting thing about Wyckoff is that all the indicators that he uses are price and volume. So these are the only indicators that are real and live in time. I could see the volume always occurring. It's much easier today with computers that give you the actual real volume, unlike when I traded on the trading floor in the S&P 500 pit at the CME, at the S&P 500 trade in the 1980s. There was estimated volume. When a market would go up one or two ticks, or one tick, it would assign a certain volume to it. As I said, there's an estimate or guesstimate volume, and basically this volume came close to the volume that was actually traded the next day when the exchange produces the sales by price, how many sales were done at a particular price. So Richard D. Wyckoff believed in the trading ranges as the market went through a campaign of markup or markdown. And since we have talked about a trading range for a bit, let's talk about what that trading range represents. This is the current E-mini S&P at the Chicago Mercantile Exchange. You can see a reaction low right here on October 29th, 2018, and the market's price was $26.03. with this market had a reaction. There was probably some type of value that occurred at this level. The market was bought, and the market went up and retested the area where the previous high was before. This forms what we see is what we call a trading range, which was mentioned. So this trading range that we have here is a situation where the market will continue to go back and forth until there's some particular news or event that will move outside the range. Actually, Wyckoff was a technical trader, but he quite well knew the fundamentals of the market. And in doing so, he believed that the fundamentals were priced into the markets. As we know that there is nothing that is perfect in a trading world, but we could deduct by watching the price and volume the feed and greed of the markets that occur to the markets. This is extremely important because we could tell the essence of what the trading range, what the market has value, and what the market does not have value. But before I go much further, I'd like to do a disclaimer since I'm an NFA registered broker. So let's do a disclaimer, which unfortunately I should have done in the beginning, but I'll do it now. There's a substantial risk and loss in trading commodity future options. Past performance are indicative of future results. The opinions of Gary Full and LTG LLC and are not to be taken regular convention of buy or sell commodity options. This is based on a teacher of Richard Wyckoff for educational purposes only. So as the market navigates through the trading range, the market then goes through a period of building the cause to the market. This sideways behavior is what we call cause building in the markets. As we can quite see in the market, that as the further we go across in this trading range, the more sideways we become, the larger the cause begins, and it continues to go. The market will oscillate until there's some event that will cause the market to leave this particular trading range. So the cause is sideways. It's like gasoline in a car that goes sideways, and we could judge by point and figure a guesstimate of how far this cause, what the effect of this cause is. You put a gas in a car, you fill it up with 20 gallons of gas, you have 20 miles per gallon. The cause is the gasoline of 20 gallons of gas, 20 miles a gallon. I'm 20 gallons times 20 miles per mile, and you get a distance of 400 miles. Sometimes you get 390, sometimes you get 420, sure. It's a rough guesstimate of the trading range. So that's the cause and effect principle of Wyckoff. The effort versus result, which is extremely important, which occurs probably every day in markets, in my opinion, is if a stock has 1 million shares that are traded and goes up $1. The next day, if the stock has 1 million shares traded and the stock does not go up at all, the effort was the same as the day before, 1 million shares, but the result was different. One was up $1 for the million shares, and the other was unchanged, million shares. So we consider the principle of effort versus result. Our next principle is one of demand versus supply. Simply put, the larger the range, the larger the volume, the more of the demand and or the supply occurs. If you look at this chart here, you will see a market and a behavior that has a large range bar to the downside. Large range down to the downside. This is what we consider a supply bar to the market. A supply bar to the market. If we have a bar that it just goes lower for the particular day, with not a large spread and not a large volume, that can be just a selling bar. Conversely, If we have a large upside bar with high volume, that could be a demand bar, but a day that simply goes higher on volume that's not so high would be a buying bar. And we judge the market by its action behavior by the area that the volume occurs for the previous days. Why the particular area? Because summertime in grains gets more volume than wintertime in grains, so we must compare the volume to each other. Very important aspect of the market. So in this first lesson with our YouTube that we have the trading range. We discussed the 3 principles of Wyckoff. We discussed a little bit about Richard D. Wyckoff and who he was and who he watched and who he interviewed in the market behavior. Richard Wyckoff didn't invent anything. All he did was judge the market by its actions and reactions of price and volume. With Wyckoff, the only tools that you need are price and volume. As I mentioned, is they're only a point in which they're shown live in real time. Other indicators like RSI, ADX, all your favorite indicators are lagging indicators, and based upon the market action, which Wyckoff describes. Do they work? Yes, they do. Do they fail? Yes, they do. But again, they're lagging indicators to what happens. Why not have live indicators in front of you to make your decision? Like a detective, collect information today where the suspect could be, not where he was 2 weeks ago. So I want to thank you for your time for the first YouTube webinar about Richard D. Wyckoff, the introduction. Again, I will be posting more about price action and volume and going through the 3 principles. Everything is based upon these 3 principles.